In this video, I'm going to talk about four key accounting terms. These four terms are really the alphabets of the accounting language. If you know the alphabets A, B, C, you can write sentences. And if you know these four terms, then you can converse or you can write in the language of accounting. So let's get started. The video is divided into two parts. In this video, I'm going to take up the first half, four topics, and then the remaining four are going to be taken up in the following video, part two. So I'll talk about the four terms, I'll name them, and then I will try to, explain to you what those terms mean by, in these two sessions, and then I'll establish the relationship between the four terms. Let's get on to it. The four terms are assets, liabilities, incomes, and expenses. These terms are not something you've not heard of. I'm sure everybody has come across these terms. However, our interpretation of these terms, our current interpretation is in terms of English language. All we need to do is now to translate into the language of accounting language. That's what we are going to do in this video. We will say asset, liability, income, expense is not what you think they are. Let's agree on the definition of these four terms. And whenever we are looking at financial reports of a company or we are conversing about financial results of a company, we should always refer to these words having certain specific meanings as per the language of accounting. Okay, in order to explain these four terms, let's begin with more understandable way of explaining these items. Sources of funds for a business. Where is it that money comes from? Where all does the funds come in from? And I have a list for you. You can get your shareholders to invest money, so that's one source. You can go to the bank or go to friend, families, and fools, as they say, 3Fs, and get funds for yourself. That's again source of business. You could sell goods and services, whichever business you are in, and you make some money from there. And there can be some other peripheral additional sources of income. You make some commission on a small new assignment you pick up in the business. You make some fee by way of some consulting assignment, or you put money in the bank and you have interest that you get. These are some representative items which bring in money to the business. There can be more, of course. Now, the first three items, investment and loans, these three items, they have a specific nature. What is the nature? These things are long-term sources. What do we mean by long-term? In accounting, we define long-term as more than 1 year, typically, right? So if somebody is investing money, the shareholder is investing money, they are at least going to stay invested for 1 year and more. The time horizon is larger. The amounts are also bigger. You're starting a business, you're not looking for thousands, you're looking for lakhs of money. Then these resources, loans and investment by shareholders, these sources are kind of one time. Now you would argue saying, you can take multiple bank loans. You can, but these are once in a while, if not one time. So typically these resources are either once in the lifetime of the company or once in few years, but not, many times in a given year. Then you need to repay the loans. You need to return the investment by shareholders as well. Typically, in case of public companies, you don't need to pay back the money ever, because the shareholders can just sell their shares to somebody else who would buy it and so on. Again, that's a diversion. I don't want to go that way. But what I'm trying to say is the first three items, the investments and loans, are long-term sources, are one-time sources, are large amounts, and you need to repay these to the people who have given these funds to you. The second set of items which you see on the screen, which is sale, commission, fee, and interest. What is their nature? These are short-term sources. Now, what do I mean by short-term? I mean sale of goods and services. You're going to sell it and you're going to make money. You don't sell it, you don't make money. Okay? And these are regular sources. You keep on selling, you want to sell as much as possible. So these are, recurring sources of funds to you. And then these can be smaller amounts typically, right? You sell one item, how much does it cost? Unless you are in the business of automobile, in which case compared to the investment you would make, the amount that you make on sale of one car is going to be relatively smaller. So please think of the relativity of the terms as well. And then you don't need to repay these sources. All you need to do is you exchange some goods or services in exchange for the sales. If you earn a commission, you have to provide a service. If you make a fee, you provide some consulting. Interest on bank, you have to lock your money in the bank. So these four items are short-term sources and recurring sources. Regularly you get money. And you don't have to repay this money back. You just give something in return, in exchange. So these are the differences between the nature of the two types of items on the slide, and all the items are source of funds. Now, can we give names to these two categories of funds? And when we do that, the first category is called liability, and the second category is called income. Okay, the money comes into the business from two sources. One is liability, second is income. And suddenly all of you are thinking, hey, liability means you have to pay it back. Yes, you have to pay it back, but you have to pay it back because you got that money into the business in the first place. Again, please, think differently about these terms. You are learning a new language, so you need to empty your cup first. Do not associate the existing meanings of liabilities and incomes in your mind, and try to learn this new language where liability is a source of income. It's a good thing for us as well, but it comes with a condition. You have to pay it back. There is a commitment of interest maybe that you have to pay on it. So there you go, two terms, liabilities and incomes, both sources of funds, and now I have clarified what these two terms mean. Let's talk about use of funds. Now, you use the funds in the business to purchase, land, machinery, vehicle, all the resources which you need to manufacture the goods or to operate the business. Then you, possibly if you're in manufacturing, you have to set up a plant. You have to buy various equipment to run the plant as well. You have to hire people, you have to pay them salaries and wages, you have to travel for business purposes. There is stationery which you require, advertisement, electricity rent, you name it. You can, I'm sure anybody could come up with tens of items where the funds can be used in a business. Now again, we're going to repeat the same exercise. Let's look at these items differently. Can we categorize them into, based upon their nature, recurrence, sizes, and so on? Here, we can categorize again these into two. The first category typically gives you a long-term benefit. Land, machinery, furniture, everything is going to help you for more than 1 year. Again, long-term, short-term. Short-term is 1 year, long-term is more than 1 year in accounting. So you get long-term benefit and you purchase these items one time. You don't continue purchasing land. Well, if you're in the business of land, then that's a separate business. I'm talking about a regular manufacturing business, let's say furniture manufacturing business. So we're talking about purchasing land once, setting up a machinery once, buying, delivery vehicles and so on, and furniture for your staff as well. At best, you may buy these things after a few years, but not very regularly. And all these things help you build capacity in your business. What is capacity? Capacity meaning, if you are manufacturing business, then capacity to manufacture more. If you're in services business, then capacity to provide more services. So these things are helping you build capacity. You're not getting these things to typically sell off. The other category that we have on the slide is salaries, travel expenses, stationery, advertisement, and electricity bills. All of these provide you some immediate benefit. You take services from people and you pay them salaries. You pay salaries monthly, you pay wages daily. Blue collar versus white collar distinction. Then you have travel expenses. You travel, you pay the money. Immediate payment, and if you have to travel again, you have to pay the money again, right? Now, if you don't want to spend on travel, you buy a vehicle. But when you buy a vehicle, it becomes a different nature of item. Advertisement, electricity bill, all these things are regular items of spending, and they help you in day-to-day operations of the business. That's how these two categories are different, and I've already showed you the first category is called assets, and here the second category is called expenses. Both assets and expenses are a use of funds. You spend money on both of these. Expenses help you run day-to-day operations in a business. On the other hand, assets help you build capacity for the longer run in order for smooth functioning of your organization, production of goods, creation of services. All of that is facilitated by assets. Now, stationery, advertisement, all these also help you, in production of goods and services. But the other difference in the nature is that they give you immediate benefit. These things don't result in building capacity for you. They only help you in the short term, but the assets help you in the long run. One more time, please empty your cup. You have to think about assets and liabilities and incomes and expenses in a very, very different light. I understand that assets is very generic term as well. You think of your personality as an asset, your communication ability as an asset. But unfortunately, all of that has no place in the language of accounting. We think of assets. We're thinking about uses of funds in order to build more capacity into business for the long run. All right. So these are the four terms, and now let me use these four key terms of accounting, the sources and uses, and try to illustrate to you how a business functions and how these four terms make up the whole process of transacting in the business. Now, you begin business and you bring in some money from the shareholders, you take loans, right? Money comes into business, and this money is with you to, for a longer duration of time. You have to pay it, but it is with you for a longer duration. When you have money for the longer duration, what do? You buy things like, land, machinery, which will help you build capacity for the business. So use all the liabilities, the funds coming from liabilities, and you build assets. Therefore, and also you cannot buy more than the funds that you have. You have funds from liabilities, and you can use these funds to buy assets of an equal value. That's how you see this equal to sign. You bring in sources, and you have only those sources to spend on building the assets, right? That's how I put an equal to sign between assets and liability. Okay. You got the money, you develop the capacity. Now what do? Now you manufacture and you sell. So I'm going to sell, and what's going to happen? I'm going to make money. So I make money, I call it income. In order to make money, I have to spend money, I have to hire people, pay for rent and other things. So I'm going to pay all the expenses. So you generate income, you pay expenses out of this income, and you get a resulting item called profit. Whatever is in addition to the expenses, the money that you make is called profit. After making this profit, what do you do with this profit? Who does this profit belong to? Well, this profit belongs to the people who put money into the business. Who are those people? Those people are the people who supplied you funds, the sources of liabilities. They get a right to take the profit. Now, they can decide to use the profit, or they can decide to again use the profit into business. So you can buy more assets. If you can buy more assets, you have more capacity. If you have more capacity, you can make more money. When you have more money, you make more profit. More profit means more liabilities, and then you can generate more capacity, and then you can have more income, and then more profit, and so on. This is how you grow a business. You are trying to maximize your incomes, minimize your expenses, and hence maximize your profit, so that this profit can be channeled back into the business to generate more assets, so that you can generate more income. That's how businesses work. And that's how, if you know about these four terms encompass all the different types of transactions that take place in a business, day to day basis or in the long run. Whatever transaction, name a transaction, and I will say, as a result of this transaction, either an asset is being created, a liability is being created, an expense is being made, or an income is being generated. Call any type of transaction. Therefore, it means that the financial reports of a company, all they are going to do is going to categorize various transactions into these four and show it to you. And now you know the alphabets in the accounting language. You know what are assets, liabilities, income, and expenses. And when you look at the financial statements, which you will in the future videos, when you look at those statements, you will know, hey, I know this, what the assets mean, I know what liabilities mean, and incomes and expenses. Great. So I'll see you in the next video.